Hi all, as a continuation of our video series on the mutual funds, this time around we are bringing a very new category which is towards large cap. This is actually been offered from ITI mutual funds. Says this is an NFO which has been offering from ITI mutual funds, predominantly to large cap. So I would like to start with introducing George, sir. George Heber Joseph is the CEO and CIO of ITI Mutual Funds. He's been there in the industry for 20 plus years, especially into financial services and mutual fund industry. He is one amongst the instrumental person to ideate Balance Advantage Fund in India. Welcome, George, sir. Welcome very much. It's been an honor to have you on the show. Yeah.
Thank you, Uday. You know, it is a pleasure to be here today and to interact with you.
Wanted to know why large cap at this time, sir?
It is pretty simple, Uday. You know, what we believe is that, you know, whenever there is a valuation, comfort on a set of stocks, and when you look at the situation today, is that the liquidity is booming. And especially because of the liquidity pumped in by US, the liquidity is going to be massive in the next 12 to 18 months also. For what we have seen, the inflow from FIIs is only a tip of the iceberg. So it is going to be massive in the coming 12 to 18 months. Having said that, what is important is that, you know, you have to identify the opportunities in any market situation. For many people are thinking that large caps have moved up significantly and therefore the opportunity is not there. Maybe markets are, at the frothy valuation. So these are the concepts at this point in time. But I want to demystify that, saying that, you know, if you look at the top 100 stocks in which is normally called as a large caps as per AMFI guidelines, out of which 20 stocks are expensive. I also agree with that, but balance 80 stocks are very cheap, right? And all these companies are predominantly, very strong balance sheet companies. They are leaders in their respective fields, in the respective sectors, and they're monopoly businesses also, sitting on huge cash pile also in many cases. And they are part of the core economy as well as they are part of the ancillary sectors. So when you look at the earnings growth scenario in the next few years, the core economy led companies are going to benefit the most because the economic growth is visible across board, and globally also the growth is picking up, and alongside, you know, you are having a significant money flow also because of the huge liquidity pumped in by US. So it is going to be a massive wealth creation opportunity in the next 3 to 4 years, which people should not miss. For that, I thought, we discussed as a team and we found that, you know, buying into a cheap large cap companies at this juncture, if you create a bunch of large caps as a basket and create a portfolio, that will be nothing like it. So people can play a very attractively valued basket today and create a fantastic return experience over the next 3 to 4 years. That's why we are launching the large caps.
Oh, it's predominantly what I would say is bottom fishing happening in the large cap segment is what it is, I believe, right, sir?
Right. You know, sir, if you see, Uday, in last 10 years, many stocks and sectors have not been doing well, you know, especially which are linked to the core economy, be it commodities, be it, utilities, infrastructure, construction, real estate, and capital goods, and some of the core corporate banking companies. They all peaked out during the period of 2008 to 10. And then last 10 years, it has been on the down cycle. So you are getting all these stocks at a fraction of what it was in 2008 to 10 period. Just to give an example, Punjab National Bank used to be a darling for most of the mutual funds as well as investors in the year 2008 to 10 period. And they used to be a part of the blue chip portfolios, 4 to 5%. And today, if you, and you know, the stock was trading at 630 rupees at that time. Today, the stock is trading at 30 rupees, and people don't even like to touch these companies. So these are phases of the market, and I believe that the business cycle for the core economy led companies is turning after 10 years. So it is like a decadal opportunity that you are getting. So we cannot miss it.
So I was going through with your one pages, your SQL investment philosophy, something which is very unique. Just can you enlighten us with that? That would be.
Yeah, it is. It is pretty simple. Uday. If you look at what is that an investor should do ideally to make money, you have to buy things cheap, and you have to buy companies which are good quality companies, and you have to buy companies which doesn't have too much of debt. So this is what basic prerequisites for making money in investing, so that you are taking the right risk as well. Yes. So if you look at the SQL, S stands for margin of safety. So margin of safety means very simple. If you want to buy a 100 rupees worth of stock, right, for the intrinsic value, or the company is valued at 100 rupees, but depending upon the institutional selling pressure or various other factors, the stock might be trading at 30 rupees in the market. So this is pretty much easily possible in a equity market kind of scenario. For 100 rupees valued stock is available at 30 rupees in the market. So you go and buy at 30. And when it becomes 100, you again sell it in the market. So when you're buying at 30, you are having a margin of 70 rupees. That is a margin of safety, because you know that it can go back to 100. And it, because of the temporary situations, people go and dump the stock, and you might get it very cheap. So that is margin of safety. Second is quality of the business. Any point in time, when you're going to buy a shirt also, you will ideally want to buy a good quality shirt, and at a cheap price, right? So that is a simple human tendency, but that doesn't normally be seen in the stock markets. Like March, you are getting a high quality business very cheap, March 2020, but nobody wanted to buy at that time. Today, everyone wanted to buy, right? For the situation is that when good quality things are available cheap, you cannot miss it. For that is, or you are getting, most of the time good quality businesses will be trading at a fair valuation. It will be very cheap, nor it will be very expensive also. Sometimes it will be very expensive as well. So whenever it is expensive, the incremental returns will be lower, so you have to leave it. But whenever it becomes cheap, you have to go and buy at attractive valuation, and those opportunities you should never miss. Right? Today, in my view, high quality companies, great businesses, monopoly businesses, leaders in their respective sectors, and the business cycle is turning in their favor. Those businesses are available at a fraction of what it was trading 10 years back. So and you're going to make mega money there, and that opportunity you cannot miss. So SQL stands simple: margin of safety, quality of the business, and low leverage. Low leverage is also very important, because if you are buying things, buying a company which is having a lot of debt, what happens is that if the business cycle turns, corona comes in or something else comes in, these businesses can go into bankruptcy. If you are having a lot of debt, if the company doesn't have too much debt, they can ride through the volatile periods very easily, right? And that is the beauty of not having debt. And that debt is always a double-edged sword. People might, in a good economic cycle, debt can be very good because the leverage benefits you get. But most of the time, as an investor, you have to be safe while investing, and don't lose the capital. So that these three letters to remember is very, very important in investing, and that's why we have kept it as a our investment philosophy, and it is part and parcel of our everyday investing process.
I also agree on it. How do you feel about PSU, which I feel, I think you're very bullish on this particular
Yeah.
time of it. So what's the thought behind it? So like, the meaning.
Yeah, so basically most of the PSU stocks today are part of the core economy, core to the economy. Say for example, power generation, which is very, very important for a country like India, where humongous electricity led requirements are there, be it industrial requirements as well as the home consumption requirements. Power generation company is a core to the economy. Say for example, steel or aluminum manufacturing companies, they are again core to the economy, because unless otherwise you make steel, you cannot make cars. If you don't make aluminum, you cannot make the engines for cars. So as simple as that. So and the requirement is massive. These kind of companies have been going through a down cycle for the last 10 years, because generally what happens is there is a boom in any sector which picks up in different market cycles, and we have seen the similar situation in the year 2000 to 2002, where all the PSUs were trading at ridiculously cheap valuation, and like BHEL and so on and so forth. And eventually what happened, the capital expenditure which the private companies and PSU companies do started picking up, and global growth was supportive. Inflation was moving up, and eventually the PSUs got re-rated massively. Right, and from 8p, 5p, 8p stocks moved to 80p stocks in 10 years time, between 2010 to 2000 to 2010. To my mind, the similar situation is coming. Globally, inflation is picking up. In India also, inflation is moving up, and you're seeing the global growth picking up. China is going into the growth mode. India is going into the growth mode. Japan and US in the growth mode, and Europe also picking up. It is going to be a fantastic environment where the growth is picking up, and the PSUs are trading at a ridiculously cheap valuation. No, anything connected to the economy, right? Core of the economy. I think those businesses will stand to get re-rated, as well as they will their earnings growth also, including the September quarter which has been published till now, has been phenomenal for many companies, and it is bound to increase further. So in my view, the earnings growth which we have been waiting for the last 4-5 years is coming back, and these PSUs are going to get re-rated. Not only PSUs, anything connected with any company which is connected to the core of the economy, I think are going to do very well.
Which are cyclically bottom as of now, is what you are.
Absolutely. So if you see the corporate profitability in India is at a 20-year low. In 2002, 2003, the corporate profitability to GDP ratio was around 2.5%, and it is below that level at this point in time post Corona. Even before Corona, it was nearer to that, 2.5%. Now it is below that as well. Fine. In my view, this is a mean reverting number, and as the GDP picks up, and as we see the growth coming back globally as well as in India, you're going to see massive boost in the corporate earnings also, and which is generally beneficial in an inflationary environment, which is the case today. So overall, I believe that the business cycle which we saw between 2000 to 2010, and that is going to get repeated, and massive opportunity to make money is coming. And most of these sectors, what I mentioned, be it manufacturing, capital goods, industrial engineering, real estate, utilities, and corporate banks are trading at ridiculously cheap valuation. So there is less of downside and more of upside kind of situation, which I can think of.
Any target for the Nifty or something which you can actually sell?
I think the earnings growth is going to be the key driver on one side, and secondly, the liquidity is going to drive the valuation. Both put together, to my mind, 3 to 4 years from now, the returns that you should expect should be to the tune of 15% CAGR minimum, and in the broadline index, and that is what you should expect. We have not seen these kind of returns in the Nifty in the last 10 years also, mainly because of the fact that the corporate earnings were on the down cycle. And as I mentioned, it is at a 20-year low, and how much more it can go down. For to my mind, that entire business cycle is reversing. Therefore, the corporate earnings is going to be in a very, very interestingly, very attractive zone. You are going to see high growth periods starting from 2021-22 itself. And unless otherwise something else comes in and derails, I believe that we are going to see a good economic growth cycle in the next 5 years. That means 5 years later, when we look back, many of us who have not invested would feel very bad because the return opportunity would be massive.
So large cap NFO is going on now, which is from ITI mutual fund. It's already a period started from 4th. It's going to end on 18th of December 2020. I would always urge all my clients to invest on a top quality mutual fund. So how do you recommend, how do you feel ITI large cap will fare, sir, when it comes to competition?
Yeah, it is. We are going to have a very differentiated strategy, as I explained. We are going to focus only on the very attractive segment of the markets and a segment of the large caps. And in that way, the portfolio will be significantly different from rest of them. And that also means that re-rating potential as well as the earnings growth potential of the portfolio, what we are going to construct, is going to be the best in the industry, one of the best in the industry. In that regard, the return also what you should expect, risk-adjusted return, in my view, in next 5 years can be very, very interesting. For overall, what I would say is that the portfolio will be unique. We will be avoiding some of the perceived high quality names like FMCG, consumer staples, retail, consumer financing businesses. And we will be investing into the old economy stocks, which are very, very cheaply valued or attractively valued. And at the same time, we have a very strong risk management framework which we have put in place. So that suggests that you not more than 7% deviation in any sector which we would like to take, so that if the benchmark weight is say 20% for a sector, we will be at least having 13% in the portfolio, or we might be having 27% in the portfolio. So that is the leeway that we are giving to the fund manager.
Okay, so you may overweight on certain sector if needed. That's what you're saying.
Absolutely. So we can, for enough freedom is there, but at the same time, large sectors will not be completely missing from the portfolio, so that you are not taking any undue risk. And lastly, the portfolio, what I feel is the stock deviations will be definitely be taken, and that is a way that in large cap fund you can actually make a good amount of returns. If you look at the portfolio, any portfolio, there are 3 ways to make money. One is by taking deviations in the stock weights compared to the benchmark, number 1. Taking the sector weights deviations compared to the benchmark, that is number 2. Third is by changing the market cap allocation. So in the case of large cap fund, we are going to buy only a pure large cap. There are many large cap funds which are having mid cap also 20-25% as allowed by SEBI. So we are not going to make it. This will be a pure blue chip fund, but we are going to buy. We are going to construct. So we will never buy mid and small cap in this portfolio. We want to be a true to label fund. And secondly, and also the lastly, what I want to say is that the portfolio, in that sense, it will be a very unique portfolio, since we don't have a market cap deviation possibilities in a portfolio, because it is a purely large cap fund. And then secondly, the other opportunity is only on stock deviations and sector deviations. So I mentioned about the sector deviation limits and stock deviation limits. This is good enough for us to play around and make significant and significantly differentiated returns related to the peers.
How about the allocation time, sir? How much time you would take to allocate completely the amount? How it's going to be like?
Generally, we have a simple process which we have set in place. any point in time we are collecting money from the market, definitely that is the time that we would like to buy those stocks. Right, and that is the reason we are collecting the money. If we are not comfortable with the valuation, we would not have come with the fund itself. We are very comfortable with the valuation. In the last 8 to 10 months, these stocks have actually gone down, or the last 3 years they have been going down. So we have good cushion in the price points what we are buying. Even if nothing happens as what we think, the downside still is not going to be that material here, because what people have bought in the last 3 to 5 years, that only they can sell. Whereas if you have not bought, how will you sell? Right. So what we feel is that in that way there is a lot of margin of safety in the portfolio, and you need to have a 3 to 5 year horizon while you are investing. That is very important, because the portfolio can do well, especially in an equity product. You have to give time, because making a baby also, it takes 9 months time, and if it is much complicated than that, and therefore you need to give more time, and don't expect the baby to run in a year's time, right? And that is what you have to give time for the investments. Then the opportunity or the return potential will be massive. So I think that we will keep a window of we have put a board policy also, that within a month's time we will invest 80 to 90% of the collections. So that is very much required, because if it is to be sitting on cash, ideally the investor himself should sit on cash. Why should we collect money and sit on cash? So that is the way as a fund manager, we have to manage money and run it with the utmost efficiency. And sitting on cash and all those things, you can only play with luck, and not by skill. So skill is by investing into it and making returns for investors.
That's very true, sir. That's very true. It's a very thoughtful session, actually. We would, these kind of sessions, I would request you to please, give us time more on some other segments as well, so that we can keep continuing discussing on such kind of funds. So I would recommend all my clients to participate more on this NFO. So it's a good NFO which is coming up from ITI. So specifically on they're focusing on bottom fishing on the large cap segment. So thank you, sir. Thank you very much. So
thank you. Pleasure talking to you, and it has been wonderful talking to you today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.